Welcome to another episode of the Capital Playbook. My name is Charles Williams. I am the owner and managing member of Pioneer Realty Capital. And today we are so excited to bring a program to you that I know you're going to be interested in. Now, we talked about acquiring hospitality projects in a previous episode. Today, we're going to spend a little more time talking about financing hospitality projects and what goes into financing a hotel and what you need to know about that. Now, I may not be the best qualified person to have that discussion with you, but I brought in an expert, Mr. Zanes Smith. Mr. Zanes Smith is with American Bank Dallas, and that's kind of their niche, if you will. Depending on where you're from, they may say niche, but I'm a Texas boy, so I'm going to say niche. Based on their niche, they focus and they specialize in hospitality lending. So this is going to be a great episode for those that are interested in learning how that works. Now, before we get into our discussion today, there are a couple housekeeping things we want to do. If you're watching our podcast or you're listening to our podcast on Apple or Spotify, please do us a favor and subscribe to our channel. And then also like this episode. That tells us the content that we're providing you is valuable and it's useful. And it also allows us to get more guests that can come in and share their expertise on commercial real estate subjects that no doubt you are interested in. So please be sure and do that for us. So with that being said, let's talk to our guest, Mr. Zanes Smith. Zane, how are you today?
I'm well, thank you.
Good, man. I'm so happy to have you here with us today. Tell us a little bit about your background. How did you get into banking and finance? Tell us a little bit about that.
Yeah, absolutely. So I spent right out of college, out of 2009, the financial crisis. So
bad time to get out of college.
I know, right?
Right.
So worked for Wells Fargo, then kind of got tired of that, went into the government space. So I spent 8 years, the bulk of my career, regulating banks. So I was a bank examiner.
Okay.
And then was looking for something new, leveraging that experience at the regulator side to go to a bank. I knew the guys at American Bank Dallas. I actually was their examiner in charge for some years. So they knew me, I knew them.
Right.
And so
government side, private side type thing. Yeah.
So jump ship, and now I sit on the other side of the desk from the regulators and help American Bank on their team.
Wow, man. I tell you what, if I was going to start a bank, that's probably where I would start, is go hire a regulator to be an executive in my bank. Well, that makes a lot of sense. So, Zane, we hear a lot of negative things about hotels. In fact, over the 19 years I've been in business, one of our biggest funds that we lend out of that used to be a huge hotel lender for the last 10 years have not made one hotel loan because of this negative press. Are hotels really that great of credit risk?
So I would preface that with not all hotels should be treated equally. So there's different hotel classes. So your some hotels are going to be tailored toward your transient highway traffic, and some may be just business travel. So as we knew in COVID, business travel stopped.
Right.
So those hotels that were centered or catered towards the business traveler or the conferences, those got hit way harder than your economy or your highway hotels that there were still truck drivers, there was still construction. So they were still performing well compared to a business travel hotel.
That makes a lot of sense. So those hotel branded, flagged hotels that catered to the business traveler, those are the ones that were hit the hardest during COVID.
Absolutely. Yeah.
But that economy brand, the economy flags, or maybe even non-flagged hotels, they performed well during COVID?
In our experience, and we focused in on that asset class, the economy, limited service, flagged or non-flagged. Those, in our experience, outperformed all the other hotel segments, and were great or low credit risk to us through that downturn because they frankly didn't see much of a dip in revenue. They were controlling expenses better.
They didn't have a royalty to pay.
Sure,
some of them, right? If they're not flagged,
and so they performed very well through the COVID period and have done well.
Wow, that is crazy. So now, from that bank examiner perspective, when you're looking at the balance sheet of a bank that's heavily focused on some of these flagged convention center type hotels. What would you, well, I guess you were not an examiner then, during that period of time, but what probably would you have seen on those?
Yeah, so I could almost guarantee a lot of those were in payment deferrals. There was some modification to the loan, some interest only to let them weather that storm, get out of it, get back to regular terms. And so those banks were probably heavily scrutinized from the regulator. As opposed to us, we had zero deferrals, zero workouts as a result of COVID because our hotels, our loans have been performing.
Yeah. Wow. That's interesting.
Yeah.
So now, and a lot of people really don't understand how the inner workings of a bank. You and I were having a conversation earlier about, there are all kinds of lending institutions. You have your private non-bank world out there. That it's not regulated by an examiner. They don't have to worry about the federal government sending an examiner in to look at their books, right? That is correct, right?
Correct.
Okay. Whereas with a bank, they have to be very careful because when they start having a lot of deferrals on their balance sheet, that shows up. Does it show up as a contingent liability, or how does that work?
So that'd be a non-performing asset.
Okay.
So that would be NPAs, and so that goes into the classified, and there's all kind of ratios and everything that we won't get too deep in the weeds. But yeah, absolutely, when you're making those deferrals or your loans aren't performing, that's showing up on reports, and then you're getting scrutinized by your regulator.
Yeah, so that's going to limit the amount that could potentially limit the amount of loans or new loans that a bank could go out and secure.
Sure. Yeah.
Right, and of course they're in the business of selling money, so if that limits those loans, then that could be a problem. Well, that's interesting. And again, the main reason I want to talk about that just briefly, even though that's not our core subject, is I really wanted folks to understand that banks are regulated. They're regulated for good reasons. They're taking money from depositors, which is essentially free, and they're lending it out. And if you can do that without regulation, people might lose money, right?
Correct.
And that's happened before, right?
Yeah.
So our government cares enough to not let that happen again. Now let's get back on topic and talk about the economy non-flagged hotel. Now that expression, flagged, non-flagged, that's an industry expression, and it simply means that a hotel is associated with a franchise.
Correct.
Or not.
Correct.
A non-flag being that it is not.
Correct.
Okay. Now, when you're evaluating one of those properties, what are you looking for to determine if this is the type of loan that you're going to make?
Yeah, sure. So we, I guess let's step back a little bit more. And so we have our ownership group, our board, are hotelers. So we kind of have the inside knowledge that most banks don't have. And so that's why we're willing to do hotel loans when most banks aren't doing hotel loans. It's just a flat no.
Right.
So we are receptive to hotel lending, one, because of our ownership experience. They've been in the hotel business 20, 30 plus years, have developed, managed, sold billions of dollars in the hotel space. So they know it in and out. And so that they've been giving the executive team their knowledge. And so that's kind of why we've focused, that's one of our niches.
Okay.
And so then back to your original question on what are we looking for? Obviously, in any real estate, location. You've got to be in what's the property? Is it if it's a non-flag, is it a viable location? If it's a flag, what flag is it? So
you're looking at demand drivers.
Sure, yeah.
And which is just good sense. I mean, if you're going to build something, you want to make sure that there's a reasonable expectation that someone's going to buy that service.
Sure.
So that's the number one thing: location. Make sure it's the right location. Now, does it matter to you if it's necessarily flagged or not?
Not necessarily.
Okay. So if it has good demand drivers in the right location, but it's non-flagged, you could get comfortable with that.
Absolutely, yeah. So if it's not non-flagged, or whether it's non-flagged or flagged, we're looking for seasoned operators. So we want someone that's
has the experience.
Correct. We don't want the new guy off the street. He bought a hotel and wants to learn the space, because learning hotel operations, and I'm still learning it now. There's a lot of nuances to it.
Right.
So we want your seasoned operators, and then obviously we want a cash flowing property.
Right. Well, that makes a lot of sense, because one of, I think, the biggest things people don't realize when purchasing any commercial real estate asset is that there is a business on the other side of that transaction. And if you don't know how to operate that business and compete in your market with that business, it doesn't matter how great that property is, you could lose money.
Absolutely. Yeah.
Yeah. And of course, we obviously have seen that. So now, let me just paint a scenario for you. I'm a seasoned hotel owner. I have 5 or 6 flagged hotels, limited service, economy brand. Then I have 2 or 3 independent hotels, and I say, hey, Zane, you know what? I found this property. It's in a let's say a tertiary market, not far from Dallas. Maybe it's 30 miles outside of Dallas, but it's Main and Main. Good traffic, right across the street from the football stadium, and there's a hospital nearby, and there's a big old what they call it, Buc-ee's truck stop across the street. I think this is a great deal. Okay, I come to you. What is it going to take for me to convince you? What do you need from me in order to determine if you're going to give me a loan to do that deal?
Is it a construction or is it a existing hotel?
That's a good question. Let's say it's construction. Let's go with that first.
We're going to look at it a whole lot closer if it's construction.
Right.
Because as you know, construction adds another level of risk.
Right.
So we're doing very little construction. We're focusing on the
existing
acquisitions.
Okay, so let's say we're going to acquire something, but I'm going to acquire this hotel because I think it's probably undervalued because of the current operations. Now, I have experience. I look at this thing and it's like, man, this thing should be performing better given its location. It's not doing very well. What would I need to do to convince you that I'm qualified to acquire that property, turn it around, create a profit for both of us?
Yeah, so obviously we're going to look at the historical financials, 3 years historical on the property, and then 3 years on you personally, and then your other assets, see how you've been managing those.
Okay.
It generally always comes with a conversation. We all get in a room. Our owners generally can look at those financials and know if it's been underperforming or the current owners aren't operating it efficiently. So that's kind of gives us a leg up as well.
That's that expertise you
Correct.
have.
Yeah,
Right.
so our chairman is in the bank almost daily. So he's heavily involved. All of the credits discussions go through him as well on hotel loans. So we can pull up a spread, look at the financials, and he can look at line items and say salaries are too high or maintenance or just any of the P&L items. That doesn't seem right for this type of hotel.
Right.
So then when that acquirer, that potential borrower comes in and says, I'm going to cut these costs, he will know
if they can be cut. Right.
Correct. If that's viable or not, if that's just him blowing smoke.
Wow.
And then, of course, we're always looking at projections. Are your projections reasonable? Are they in line with the industry and with the appraisal?
And so, are there outside industry documents that you're going to use to measure the performance of the market and the hotel? I know you mentioned appraisal. Are there any other type documents you look at?
So everyone knows the STAR report that looks at your property compared to your competitors. So that'll compare your occupancy, ADR, RevPAR. So we're always looking at those. And then there's also internal data points that we can get your revenue in your market on your specific hotel, and then also all the other hotels in that market, to see if this is a Motel 6 and there's another one, say, a couple miles away. Are you underperforming, overperforming?
Oh, wow, yeah. Wow, yeah. And, I've always said in this industry, the numbers tell the story. Because at the end of the day, we're in the numbers business. We're making loans on property, and we want to make sure that that property generates enough income to pay back the loan at the very minimum, right? So the numbers matter. Now, in the hotel business, what would you say makes a hotel that's have similar demographics, similar economics, similar demand drivers, but one outperforms the other? What do you suppose are the differences between those two in your background?
Yeah, honestly, I think it's the operator. So a lot of the borrowers we cater to they live on site. They're doing a lot of the work.
Right.
So if you have a someone else managing it, or an asset management company, that's not going to perform as well, because you got extra expenses. You have more staff. Well, when you own it and you're there living on property, and maybe your wife or your kids are doing the housekeeping, that's naturally going to lower your expenses. You're more invested in that property. That's your livelihood. That's generally going to outperform someone it's just a true investment, and they have someone else managing it for them.
Yeah, that makes a lot of sense, because I'm telling you, if I owned a small independent hotel and I live there, I'm checking to make sure the lights are off every day.
Exactly. Or even if the property's in good condition.
Right.
Because you'll know if a door's not painted correctly, or a room's not put together. If you live in Michigan and you own a hotel in Texas, and you have someone else managing it,
that's going to be a problem.
Yeah.
There might be a dead body in there or something. But that is the difference. And I can see why that with you guys taking that approach to measuring that credit risk. The fact that you're experts in the industry, that really makes you a good lending partner for someone in that space. Now, help me understand why a hotel owner wants to make sure that not only he chooses a bank, that can loan him the money, but a bank who can also be a good lending partner. Why is that important?
Yeah, so you always want to have a good relationship with your lender. Obviously, our pitch is our owners know the hotel space. So if it ever comes to where the credit or the loan becomes a problem credit, you can leverage our expertise, knowledge on helping that borrower, that operator, try to work that out, rather than ABC Bank down the road. If you have a loan with them and you get 30, 60, 90 days past due, they're going to move towards foreclosure. They're not going to work with you in rehabilitating and getting that asset, that loan back into performance.
Yeah. I think one of the important things, and we've had other banks on this show, and this is something we've always encouraged. I'd love to get your thought on this. What do you think the importance of a borrower, because the bank is going to interview the borrower, because they're looking at perhaps giving him millions of dollars to go execute his business plan. But why do you think it's important for the borrower to interview the bank?
That's a good question.
Yeah.
I have never thought of it that way.
Yeah.
It's a marriage.
Right.
Generally, loans are longer term.
Right.
5, 10, 20 plus years.
Right.
So
in most marriages. Right. Right.
So it has to be a mutual relationship on both sides.
Right.
And so, yeah, I've never thought of that way, but I think it's a good point that the borrower needs to be comfortable with the lender as well.
Right. And for the reasons that you just mentioned, if I have a lender who perhaps is offering me a quarter of a point rate that's less, but they know nothing about the hotel business, right? They're just happen to be making hotel loans this week. Next week, they're probably not, right? Versus a bank who's heavily invested in the hotel business, but maybe their rate's a little higher. There's an obvious benefit that exposes itself for that person in the business, because as you mentioned, it's going to be a marriage, it's going to be a relationship. Most marriages aren't always in that honeymoon stage where everything goes perfectly, right? Most marriages are in the after honeymoon stage, and that may occur in that relationship between the borrower and the lender.
Sure.
And so you want to make sure you have that lender who said, hey, you know what, I have the experience of dealing with these issues and we can work through this together, honey, right?
Yeah, absolutely. And to your point, ABC Bank down the road may be giving you a 50 basis points or a 25 basis point haircut.
Right.
But you're right, if they have zero hotel knowledge, when a covenant default or something, a past due default comes up,
right,
they're going to say, sorry,
yeah,
you've got a covenant default, you're in default, we're going to send you to foreclosure. Now, as opposed to us, we may be willing to work with you a little more,
right,
because we know maybe this time of year your cash flow is slower because of whatever reason. So we're willing to do a covenant waiver for this quarter,
right,
to allow you more time to recover down the road.
Yeah, and I know maybe some of our audience who are just getting into this commercial real estate may not understand the importance of covenants. I know even experienced borrowers don't even read their loan documents, which is a mistake. If you're smart, hire an attorney to go through your documents. Everything is negotiable, right?
Yep.
And most people don't negotiate. That's why they don't start negotiating until their loan goes bad. Then they want to negotiate something they agreed on, right? But it's so important to make sure you understand that. But one covenant that a lot of people want to understand, because I just had this happen with a client, is that global cash flow debt coverage. Okay. That's probably something you guys look at if there's a portfolio, right?
So we look at, correct, if they have multiple properties, we look at a global cash flow. We generally don't tie our covenant to a global cash flow.
Well, that's a plus.
We'll tie it to just that property.
Okay.
And then, of course, with hotels, we generally, it's just a standard covenant that you have to have. If it's a flagged, you have to have a current franchise agreement.
Right.
And then we also use a comfort letter, which allows us, if the borrower is in default with that franchise agreement, allows us to take over and operate that with that same flag.
You can transfer that flag.
Correct.
Okay, makes a lot of sense. Is it easier for you to get comfortable with a non-flag deal? It seems like if it's flagged, there's an extra level of complexity that perhaps is added to that deal. Or do you feel that the benefits of having a flagged hotel outweigh some of the complexities that are involved naturally with the flagged hotel?
Yeah, I think it depends on who you ask. So with the flag, generally you're going to have higher revenue.
Okay.
Because you have
the reservation system.
Built-in reservation system,
Right.
marketing, but then you're also going to have higher expenses because you're paying that franchise some fee. And so I may give you a different answer than someone else would.
Right.
So I think I would like to say we're agnostic on whether it's a flag or non-flag. We're more concerned about the property, seasoned borrowers, cash flow.
Okay, yeah, that makes a lot of sense. But I can tell you that I told you before we started this podcast that this will probably be one of the most popular episodes of our podcast shows because of the fact that I think the hotel industry is about to explode.
Yeah.
I think demand is building, and for folks who are not investing either in equity or debt, they are about to miss a big opportunity. And you guys have put your bet on hotels.
Yeah, so we're already seeing it in our numbers. So I'm tracking all of our hotel, our revenues, ADRs, RevPARs, occupancy, portfolio-wide. And I would say, I don't have the exact number, 80, 90+% of our loans, our hotel portfolio, is wildly, farly exceeding 2019. So pre-COVID, their revenues are through the roof because
Wow.
people are just ready to get out,
Yeah.
travel. So I don't know how long that's going to last.
Right.
But to your point, I think people are ready to get out.
Mm-hmm. And start enjoying again.
Yes. Yeah.
And I tell you what, one thing, I was in Philadelphia, and I'm not going to say what hotel. I was in Philadelphia last week. And I enjoy nice hotels. I like to stay in comfortable places. So I go and I do my TripAdvisor thing, and I pay for the experience. Yeah. So I booked this hotel. Get there. There's no doorman. Okay, there's no doorman. All right. And so, I'm a big boy. I can carry my bags, right? Go up to the thing. Hi, Mr. Williams. I had to wait on the guy to bring my bags up. It's like, I know I'm a little spoiled, right? But it's a nice hotel, right? So I'm in a suite, get up to the suite. Television doesn't work. Remote control doesn't work. It was like, there's no room service after 11. And I'm calling, and I'm like, you guys are charging me, over $1,000 a night for this hotel room. And and you operate like a limited service hotel. Mm-hmm. You know what the excuse was? What do you think the excuse was?
Low personnel, they didn't have the staff?
COVID,
yeah.
No personnel and no staff. Okay, if that's the case, then if you're going to give me limited service, charge me for limited service. Yeah. And it just blows away. But I thought about that when you said how the hotels are outperforming, because they're still charging full service prices, but they are providing limited service in a lot of cases, one because of staff and one because of these stupid COVID policies that they arbitrarily established that incidentally lowers their costs.
Yeah, so a lot of our hotels didn't have those extra perks anyways.
Right.
And so they're outperforming on the revenue side because the demand is so high, they're able to charge more for a room.
Yeah. Well, I think I'm going to start targeting some of those hotels myself.
Yeah. Yeah.
But anyway, hey, it has been so great having you on our show. But before we go, I asked you to think about the top 5 things a person needs to consider before acquiring a hotel or before choosing who their lender is going to be. What are those top 5 things?
Yeah, so I'll kind of spin it a little bit. I'll give the top 5 things that we're looking at when you're going to look for a hotel loan. Uh-huh. So obviously, the property location.
Okay.
So does it fit in our strategy? Is it that limited service, that economy, kind of recession-proof property? And then is it in a market, a location that we like?
And so what are the market locations that you like?
Yeah, so at American Bank Dallas, since we're here in the Dallas community, we've got one location in Irving and one location in Dallas.
So just the Dallas metro area?
So that's our preference.
Okay.
But we look at Texas and nationwide. We have a few nationwide, but the bulk of them are in the Texas, and then even more than that, the bulk are in the Dallas DFW area.
Okay. Wow, very good.
Yep.
So those high demand, those sustainable demand drivers, so location, that's important. Did I miss number 2?
Number 2, seasoned operators.
Seasoned operators, okay.
Yep.
And number 3?
Cash flow.
Got to have cash flow. Cash flow is key.
Yeah,
got to pay the bill.
You got to pay, yeah. Right. And so it's got to meet thresholds.
Okay.
To make sure we get repaid and you have some left over.
Yeah.
Yeah.
So you don't have to keep living in that hotel.
And then 4 is leverage. A lot of owner operators want to leverage up their property,
right?
Which is actually generally going to be at their disadvantage,
right?
Because they have more debt payments,
right?
So we're looking for deals that aren't over leveraged.
Okay, so what's your typical leverage on a transaction? Where are you comfortable?
Yeah, so it depends on if it's conventional or 7A.
Mm-hmm. If it's conventional,
we're probably in the 65-ish range.
Okay, and 7A?
7A, we're probably 75%.
Now, are you doing any 504s? Because there's no CDCs that are really lending.
Yeah,
right?
So we haven't done any 504s because of that. So we met with actually yesterday a CDC, and we asked them, "Are you doing any hotels?" And they said no. And so in our experience, there's no CDCs that will buy that 504 debenture on a hotel. So it's kind of dried up the demand there.
Yeah. Wow, that's it. And so what's number 5?
I didn't have a number 5, so I'm come off the top of my cuff.
Is that bank in the hotel business?
There you go.
Right?
Yeah.
I thought that was going to be your number one.
It should have been.
Right.
And I'll tell you this much. American Bank Dallas, we know hotels.
Right.
Our ownership knows hotels. They are owner-operators. So if you were to go to any place,
Right.
why not come to someone
That's going to be a partner.
that's in the business,
Right.
and knows the ins and outs probably better than you do.
Yeah, makes sense to me. Thank you so much, Zanes Smith with American Bank Dallas. Thank you for coming in, talking to us about the hotel business. And it is so refreshing to find a bank that's bullish on hotels. So if you're looking to finance a hotel, this is the guy to call. But again, we bring this content to you for your benefit. So do us a favor, make sure you subscribe, make sure you like these shows. That way we can continue to have the guests that we enjoy, and we can bring you content that matters. This is the Capital Playbook. If you want to win the game, you got to know the strategy. So keep joining our show, and that way we can all learn this game together.